All right, welcome everybody. Welcome to the masterclass that we have today, especially like how to really supercharge that legacy that you have with Max ROI Infinite Banking. Really excited to do this. I know several of you guys are showing up here live right now. Some of you guys are watching the recording. Welcome either way. So excited to have you on because we are going to cover some things that, although I've covered this before, I'm going to try to cover some things that are a little bit different, right? I want to take some different angles as well and add some more education. So I don't care if you've been on 10 of these classes, you're probably going to learn something new today, right? So I'm really excited to have you guys here today. As we're getting started, just so that I see who's here, go ahead and post in the comments here or wherever you post comments, because I know you guys are coming from different live sources. Go ahead and post where you're from. Just tell us where you're from. Just kind of curious to see where everybody is. I would imagine most of you guys are in the U.S., but there's possibility you might have somebody outside the country too. So go ahead and start putting that in, and just let me know that you're here. Yeah, because I can see that there's eyeballs here. I just don't know who you are. I just can't see you. You can see me. It's kind of creepy, but I can't see you. All right. So without further ado, let's just go ahead and jump right in. Oh my goodness. We actually, I'm glad I did ask if there's anybody from out of the country. We do have Jesus from Mexico. Good to see you here. We got Danielle from New York City. We got Luis from Rhode Island. We got Christopher from Nebraska. Good to see you, Chris. We got Brett from Honolulu, Hawaii. Aloha. We got Jim from Georgia, Joe from Michigan, good, and Richard from Sacramento. So definitely good to see you guys here, and especially as more of you keep jumping on as we're going along. All right. So as I said, I'm going to just jump right into this. There we go. Perfect. Okay, so I kind of changed this slightly. I know we got two different titles going on, but really I was thinking about, actually, this is not the right one. Haha, just kidding. You're not going to see that one after all. That is the wrong one. So let me go back here. Or not. Let's see. There we go. It's just a little slower. All right, let's try this again. Okay. All right, bear with me here. I'm just the worst multitasker in the world, that's all. So we'll go ahead and rock and roll here in a second. Well, that's what I did there. Perfect. So I actually almost uploaded the wrong one, but as I said, as we're getting going now, so really what I'm talking about today is like, how do we actually have more wealth now? What are some ways we can actually build our wealth today, build it faster, do it better, and do it in a way that actually allows us to create wealth today and pass it on from generation to generation to generation. Many times I've done this masterclass before. We've often just talked about what we can do with the here and now, which is great, right? How do you use it with passive income? How do you get that to pay you twice? Get your investment to pay you twice, how do you do all these things? How do you store your money that's safer than the bank? Which right now, especially as we're starting to see little signs of recession, banks don't like to, they don't like to be your friend during recessions, right? They tend to get scared themselves because they're scared that you're going to get scared and pull the money out. And so there's all these kind of uncertainties and things that happen in the world today, that we want to make sure we have our money protected. It's in a great place, and you're going to earn more than just a simple point nothing percent on your money. But can you also have it tax free? And heck, even better, can we have it protected from lawsuits and creditors? So if you guys are really looking to see like, how can I store my money in a safe place that's always guaranteed, it's always going to grow, it's protected from lawsuits and creditors, I can have millions of dollars, they can't access it. Even if we got, even taxes, right? If we be tax free, growing more than you'll get in an account, even if you're making at least 5 or 6% a year, that's the kind of thing I'm going to cover today, but also how you can actually get this to pass on from generation to generation so that your wealth doesn't decline. So you don't create a bunch of trust fund entitled babies. That sounded horrible when I said it that way, but you know what I mean, right? You don't want a bunch of trust fund babies that are also entitled. I'm using the quotes here. They're not necessarily babies. They could be full on adults just acting like babies. We don't want to have people like that, right? We want to make sure that we're, of course, doing the right things with it. So that's what we're going to talk about here today. As you can see, like, this is not something that I've done myself, but I've actually done this with hundreds of our clients as well as myself. And again, this is something that can actually shave off years towards your financial goals, especially if you're trying to create financial freedom faster. Now, my inspiration today is actually my dad, and he just celebrated his 80th birthday last month. Was able to see him, but when I was growing up, he was like the penny pinching saver, right? He always just told me to save money. He was like Dave Ramsey's older brother that Dave Ramsey would look up to, right? I think Dave Ramsey learned everything from my dad. I mean, he was the kind of guy that, he taught me great values. He taught me things about working hard, your word is your bond, to be willing to help people and serve, things like that. But when it came to money, it was always about, hey, we don't have enough of it. Hey, we can't afford this. What do you think I am? Made of money? Money's not growing on trees, those kind of things you hear growing up. By the way, if you had parents like that, type in the comments, say, yep, that was me too. Carla from Texas and Lisa from LA. Good to see you. Reggie from Augusta and Jesus. Good to see you as well. But definitely, like, he was that kind of guy, right? He was the kind of guy that just really counted every penny possible. So, needless to say, when I became older, I didn't want to live a life of scarcity. I wanted something else. And that's why I went into business. And the first business I went into that intrigued me was being a financial advisor because, hey, if I can learn about money for myself, maybe I'll have a different future. And even better yet, maybe I can buy some years of my dad's life back by being able to learn these things. So I did that. I was actually a financial advisor for several years, AKA salesman in a suit is what I did. And about 4 years in, my dad said, "Are you going to advise me at some point?" So I sat down with my dad, sat at his kitchen table there that I'd grown up at, where he was constantly talking about money all the time, just not enough of it. And as I'm sitting there at the table, I'm looking at his finances and I see that he paid off his house in 18 years. And I know he had stuffed money in his 401k and everything and getting the match, just like every good boy and good girl should. And I said, "Okay, Dad, here's the deal. You've done an amazing job paying off your debt. You are debt free. You're stuffing money in your 401ks and and whatnot and IRAs, and you're doing a good job there. Here's the deal. You're 61 years old. If you want to retire today, you better hope you die in 5 years. That's when you're gonna run out of money." And he's like, "That's not what I was hoping to hear." I said, I know, but I mean, that's the truth." He's like, "Well, what do I do?" I said, "I don't know. You did everything right, right? Everything that Dave Ramsey taught us, you did it. And that bugged me. And of course, a few weeks later, I ended up, talking with a friend of mine who was doing real estate investing. Him and his dad were partnering on deals, but his dad wasn't in my dad's plate. His dad was actually had double his income as a professor at the local university. And I said, "My goodness, that's amazing." Especially when he pointed out that our clients, all my clients, weren't financially free, like truly free, where they didn't worry about money or running out of money too early. And neither were all of our financial advisors. All the financial advisors that I knew, they couldn't retire off of the same investments. They were in the same situation, right? They were basically just as broke as everybody else. They just made good money selling this hopium, so to speak. So, anyways, I end up leaving that industry. I quit, never vowed never to go back. But through real estate investing and whatnot, I was able to retire later that next year when I was 28 years old. And so this is kind of where I've come to be. This is why I'm like the anti-financial advisor, right? Because I'm telling people, don't trust that advice. It doesn't work. And this even ties into what I'm talking about today, because I'm telling you, if you want a legacy that actually allows for greater prosperity to pass on from generation to generation, you've got to listen up here. This is very important. And I'll tell you this, right now, people are passing on less and less. The baby boomers, they were doing great. But as inflation's increased over the last several decades, and it's a lot higher than the government teaches us, right? As we have that happening, plus the markets, although they've kind of gone up, they haven't been amazing. And despite all of that, we're actually watching wealth erode generation to generation. That doesn't have to be your story. Now, I'm going to share this with you. This is not probably my least flattering picture you will find. Well, okay, there's probably less flattering pictures of me. Trust me, I'm sure they're out there. But this is one of my least flattering marathon pictures or half marathon pictures. I actually ran this last year. I was running the Bryce Canyon half marathon, beautiful location. Now, I had actually been getting faster and faster every single year. I'm now almost 47. I turned 47 in a couple weeks. And so into my 40s, I'm actually faster than I was in my 20s. But I kind of hit a head back in 2023 to the point where my body started breaking down. And this really became apparent when I went to run Boston just back in April. And in Boston, ran that marathon with a lot of the other people. This is my third major of the world majors I've been running. And I got the worst time I've had in 10 years. Why? Because although I've been working really hard at it and I thought I was working smarter, there was something that was still missing. It was this. is, guys, I wasn't doing the right things. What I learned in Boston was that if I wanted to run faster, I needed to run slower in my training. If I want to run faster, I had to run slower. You'll notice that a lot of the things that work are often counterintuitive sometimes. Now, they make common sense eventually when you start to understand the why behind it. But when you start to understand that sometimes what's at face value or what most people think is correct is not correct. And when it comes to money, it's no different. And so what I found out, as I said, I was training too hard. I was pushing my pace every single time I did a practice run. And I was doing that 5, 6 days a week. And so as I'm pushing, eventually I pushed my body to the point where it said enough was enough. And so that's why when you saw there, that's why I about collapsed at the finish line. I literally almost tripped at that very moment. I stumbled, barely caught myself, almost passed out because of the injury I had and just exhausting myself. I still did a decent time in this race, but it was horrible. What changed? I started running slower. I stopped trying to work harder and I stopped even trying to work smarter because smart taught me, hey, I should just keep pushing the pace, hire a coach. Coaches have me do the same thing, but it was all about this. It was about working right. That was the difference. When I started to run slower, I'll tell you what's interesting is that this summer now, as I've done races, I'm now just about as fast as I was in 2022, and I'm improving all the time. I had to run slower. I had to do the opposite of what I thought was true. That's what I mean by working right. Many times, even though it might seem like you should do one thing, it may not be that way. It might be the opposite. And this is what I really want to enforce is that we're going to talk about offense and defense a little bit, right? Now, I'm not talking about passive income. I did a masterclass on that last week. We're talking about how to make an extra $2,000 a month of passive income in your situation. And that one you can actually find on our Money Ripples podcast channel under the live section, which is where this will be posted as well. And in fact, you're probably on it right now. In fact, if you're watching this through YouTube. But here's the key thing, guys, is that Bear Bryant said this. He says, offense sells tickets, but defense wins championships. Guys, you would have never heard of Tom Brady if he didn't have a good front line, right? The guy would have been walloped. He would have been injured. He would never made it to his 40s in football. You would have never heard of the guy if he didn't have a good team to support him on defense as well as his front line. You need to have both. Now, you have also Wolverine out there, right? Like Wolverine says, best defense is good offense. Or is it the other way around, right? Just so you know, I'm kind of a Marvel fan. But that's true, right? It's like many times we think it's one way or the other, but you can have a good defense and a good offense. And this is not something that's just been subject to just me, right? We got guys like Walt Disney. Walt Disney actually used this very same strategy to help get Orlando to have the collateral so that the bank would give him the loan so he could actually build out Disney World. This is a strategy that even Ray Kroc used to pay the executives when he first took on the company himself. He didn't have the cash. He literally had to use his infinite banking. He had to tap into the cash to be able to do this, to have that, the golden arches, right? And this guy, you may or may not recognize this guy, but you probably recognize a store, good old J.C. Penney. During the last Great Depression, he actually used his own life insurance to be able to pay his payroll to keep the company afloat. Unfortunately, that didn't work so great after COVID in 2020, did it? But that's the thing. It still worked for him for many, many decades. He just, he's long gone, and who's to say that they're even using that strategy anymore anyways when they close. So maybe that's the problem. Maybe he stopped using it. They stopped using it as a company, and voila, they didn't have the cash. So this is the tool that, again, how many of these infinite banking? That's what this really comes down to. Now, this is also where banks store money. This is what's fascinating, guys. You look at tier one capital for banks. You'll see that they have anywhere. You'll see under the BOLI section, which is the second and third column from the right. You'll see they have anywhere from about 10 to 20% of their cash they store here in this very same place. Why would banks do that? In fact, not just banks, but I know of 2 people personally that come from a family that owned banks. And guess where they store their money? Not in their banks. Believe it or not, they don't even store money in their own banks. They store it here instead because they know they have better protection, tax free, right? It's tax never if you do it right. And of course, they have the ability to still access the cash whenever they need it. And these guys will also use it. Banks love using it because it allows them to leverage more cash. They can loan out more money because they hold their money here because it's guaranteed. So if they're using it and investors are using it, guys like Eddie Wilson, who, by the way, he was one of those people that came from that family of bankers. He's actually been pumping tens of millions of dollars through this strategy so that he can buy businesses that he's sold for literally hundreds of millions of dollars. So this is not just me. This is not just something that's been happening. This is something that's been happening for decades. But like I said, there's so many challenges. We got the stock market that finally stopped tanking in just the last week. Like we saw a lot of people lose, literally the market lose trillions of dollars in just 1 week alone. We got those issues like that. We got the government, of course, that's badly in debt. They can't even now afford the interest that they're paying on these loans. And of course, where are they going to get the money? Hey, maybe we can tap into some IRAs and 401ks. Is there a way we can incentivize people to pay us now so we don't go bankrupt as a country, right? That's the thing. You got targets on the things that you're told to put your money into that might not last forever. We got banks failing, especially back in 2023, but three big banks and that's all that fails. I think there might be some other stress, some other cracks that might be happening that we don't know about, right? And that's the thing. We lost at least two or three banks and then some other smaller ones too, but we may not be done. And then interest rates, of course, they talk about lowering interest rates, but what if they don't? What if they keep them higher still? What if they only lower them a little bit and we're still dealing with these stupid interest rates going up or down and we have no clue what's going on? As a result, we got guys like Buffett. Well, Harold is the best investor of our time right now, is now holding 189 billion in cash. Guys, that's almost $200 billion he's not even investing. In fact, that might even be bigger because just last week, he sold off half of his Apple stock. Now, he's still a majority shareholder. Well, not majority, but he's still got a good share of ownership in that company. But why all of a sudden is Buffett trying to pull out more cash? Kind of makes you wonder if he's pulling money out, what are we not seeing? And just so you know, there's always people that always criticize Buffett for being too old school, somebody who just doesn't know what's going on. But guess what? He's always the one that proves them wrong because he's always the one that ends up making money where people end up losing cash because they get too aggressive, they get too overconfident, and they get their butts handed to them, right? And so I'm going to recommend a way to unbank yourself, right? Stop holding your money in banks where you may not have your money safe at all. Because let's be honest, we don't even know if FDIC can protect your money, right? And you get guys like Dave Ramsey telling you stuff. And the thing is, he doesn't get it. I mean, he doesn't even quote correct market returns for one. Two, I mean, he's talking about doing things that he hasn't even done himself in life. He's made all of his money in business and real estate, yet he tells you to gamble your money away in the stock market, right? And so we got to have some place where we can have our money safe, where we don't have to worry about it day in and day out. We don't have to watch some stupid stock ticker or the news or wonder if the president of the United States is going to forget his own name and then all of a sudden the stock crashes, right? We don't want that kind of stuff happening. This is where this max ROI infinite banking, this high cash whole life insurance, which is not the same old life insurance that you get from your typical, become your own banker, infinite banking type of thing. They're not all equal. They're done very differently. In fact, it's more about how the agent designs it than it is even the insurance company that you use. And you got to make sure you're doing the right things. And I learned this firsthand because, like I mentioned, I was able to get financially independent back in 2006. Well, I started hearing all these real estate investors talking about this infinite banking thing. And guys, I was a financial advisor for 4 years. Never heard of that phrase before. So I read that book. I read the Nelson Nash book, Become Your Own Banker, which, by the way, is a good book. It's getting to be kind of a little bit older, and some of the things are outdated in it, but there's still some good concepts in that book. But I read that book, I drank the Kool-Aid, and I found the guy that all these investors were using, and I bought a policy through him. And I remember, I was insurance licensed too. I wasn't a newbie to this. I wasn't ignorant. And I asked him, I said, this thing seems kind of expensive. I'm paying $1,000 a month, but it takes me until my third year before I have any cash in this thing. Is that right? Is there a way I can manipulate the numbers like I used to be able to do when I was a financial advisor? And the guy said, no, you can't. It doesn't work that way with whole life. It's expensive. It's just the way it is. But don't worry, in 5, 10 plus years, you'll be able to use the cash. So I believed him. I trusted him. Well, 2008 hits. I go from millionaire to upside down millionaire. And as a result, I'm in the whole $15,000 a month. I can't keep paying $1,000 a month to something that, I couldn't afford anymore. And I called the insurance company. I said, is there anything I can do to keep this policy? And they said, no, the only way you can keep it is keep paying $1,000 a month. And so because I couldn't pay it, I lost it. $25,000 I paid into this thing only to lose it a few years later. Guys, that's like the most expensive rip-off term insurance you could possibly buy, right? It had no real benefit. But I thought, well, you know what? It's just the way life is. It's just the economy right now. Oh, well. Months later, I'm talking with a friend. And as we're talking, we start sharing notes. He bought a policy from the same guy, found out the insurance agent was wrong. We could have actually put more money in or designed it differently. So I started doing my own research, running my own numbers. And you know what I found out? He was right. It was right. I could have put more money in. And so I confronted him. I ended up having a 2-hour debate with this guy. I showed him everything. I even played a stupid little game about having a bigger death benefit and everything. So I showed him a bigger death benefit. And we were running numbers, comparing our numbers. And really apples to apples, I was beating his numbers. And it finally came down to it after I got rid of all his objections. He said, Chris, I did it this way because I could not afford to cut my commissions. I said, there, you're finally telling me the truth. And I kind of hate you a little bit right now. I will not send you any more of my friends, family, or clients to have you do their policies. And I didn't. This guy now works for a bank. Talking about unbanking yourself. That's where people that fail in this industry go. They work for a bank, right? But I was pretty pissed, you know? And so I really, since 2008, after I had this argument with him, over those years, now we're going on, what's that, 16 plus years now, right? Now we're going on that I've been trying to perfect this, to do this in a way that works for business owners, investors, even if you're a passive investor, so that you get the best ROI possible. And that's kind of where I've been, I actually came out of retirement in 2016. I was able to retire once again in 2016, had enough passive income to stop. But then 2017, I realized still I could not find somebody to do this the way that I would do it for myself. So what did I do? We decided to do it ourselves. And actually that's what we do as a company, right? Is that we actually now design these to get the best return possible that you can get out of these policies. Sometimes we refer to this as no BS infinite banking because unlike a lot of those guys where they try to not show you their numbers so that you don't shop them around, we welcome it. We're like, go ahead. I guarantee apples to apples, they won't beat us because that's just not happening. I finally, the first time in about 2 years, somebody beat our numbers in a different scenario. And I was shocked. And then what did we do? We took notes for that. It's like, great. In that scenario, we now will do the same thing. Now they will not beat us. And we actually found out we could have done it a little bit better than they did on that specific scenario. So we still end up improving upon the numbers that other agent had done. And so that's the thing, is that we make sure that we always give you the best return on the cash, the savings account that's in there, that's protected from lawsuits and creditors. You can do that. Now, who's this not for? If you're over the age of 70, this is not going to be the best strategy to use. I'm not saying you don't have insurance. You could get insurance, but I wouldn't use this strategy where you're overfunding and building this bigger tax-free savings account. It's going to be really expensive. The older you are, the more expensive it gets. Now, if you're in your 50s or 60s, you're definitely not too old. You'll see even, I got a couple people that gave me a testimonial that I'll share here later that they're actually in their 60s and they love the strategy. Okay. One of them is even on here, so funny enough. But it's not for those that, again, kind of in your 70s or 80s, a little bit harder to do. Now, somebody might also be in bad health. Maybe you're a smoker. Maybe you had cancer or a heart attack or something recently, or a stroke. Yeah, it's going to be really hard to get a policy. In fact, you might even get rejected. But here's the good news. I had a client who was kind of like that. He was actually in bad health. He was in his mid 50s. And he said, well, Chris, is there another option? I said, well, are you married? Yeah, I am. Actually, I have a wife. I said, good. Women live longer. So if you're the same age and same health rating, she'll still get better ROI because women live longer, costs her less. He said, yeah, well, she's not just my same age. She's actually a few years younger. I said, bonus, that's great. Oh, and best yet, Chris, she's actually in great health. I said, even better. So we ran the numbers on her instead. He's now putting in $110,000 a year into that plan. You know what's crazy, guys? He actually was recently involved in a lawsuit. He's still pumping money into this because the money is protected from lawsuits and creditors. So you can have millions of dollars in here and they cannot touch it. So even though he's kind of dealing with a lot of legal battles and things like that, this is where he's storing his money just to ensure that he has money safe for his own family, right? So definitely not for those that are in bad health, you're over the age 70, or if you're literally paycheck to paycheck. Like if you do not have two nickels rubbed together, you cannot even afford to put away like $20 a month or whatever it might be, this strategy wouldn't be for you. You would want to save at least $5,000 to $10,000 a year in this kind of strategy if you're going to use it. Now, if you don't have that much money, but you still want to get started on something, you can do a convertible term insurance policy that converts to a good plan. Not all term insurance policies are equal either. Most term insurance policies are not convertible. And even if you can convert a policy to a permanent one, like a whole life policy, usually they're not very good. And so we can actually design that as well, where you can at least get a cheap term policy in the meantime until your cash flow is in a better, healthier spot. But definitely, if you're over the age of 70, bad health, or you can't really save at least $5,000 a year, this strategy would not be for you. And so I would recommend, even if you want to reach out, unless you're like wanting to do the convertible term, don't, I wouldn't even bother booking an appointment. Just learn about it, get yourself in a place where maybe it works better. And yes, everybody always asks, can I do it on other family members? Yes, you can actually get on other family members, business partners. You can do that in case you don't fit in that kind of category. Now, let's talk about how this actually works and what it is. Like I said, it's like a supercharged tax-free savings account. It is tax-free now and later, just like a Roth IRA, but you don't have the 59.5 rule. So this money you put in with after-tax dollars, gross tax-free, comes out tax-free, and even the death benefit is also tax-free to your family. One of the only things that's tax-free to your family. As I mentioned, it's protected from lawsuits and creditors. In most states, it's 100% protected. That means anybody sues you and wins, they still cannot touch this money. It's one of the only places you can store your money to do that. It's only this and a 401k, and that's it. It has that kind of creditor protection. It's safer than the bank. You can literally store millions safely because it's guaranteed to keep growing. Right now, they're paying at least 5 or 6% tax-free. But how is it safer than the bank? Understand that the Great Depression, there were 35,000 banks in 1929. 6 years later, there was only 13,000 left standing. That's it. Almost 2/3 of banks failed. Insurance companies, almost none of them failed because unlike banks, even like with the last 2008 recession, if you remember that, banks could over leverage. They can loan out more than what they have in their possession. And as a result, government had to bail out some of those banks so that we didn't lose all of our money, all of our cash, right? Well, same thing here. FDIC, everybody talks about FDIC protecting your money. Guys, FDIC can only cover 1.5% of the total reserves in banks of your money. Only 1.5% is actually protected. So if 10% of banks fail, I can guarantee it's going to take a little bit of time to get your money back, right? So we got to be careful of that. Where insurance companies, they have insurance companies that back up the insurance companies. They're called reinsurance companies. They actually guarantee that even if they fail, your money is still protected 100%, including your death benefit and everything. And like I said, insurance companies, they can't do things like banks do. They can't do this kind of the risky strategies where they're loaning out more money than they have. They're not allowed to do that kind of stuff. So they're much safer. And I like using companies, by the way, that actually have been around for over 100 years and have always paid dividends above their minimum guarantee for the last 100 years or more. Some of the companies we use have done it for over 175 years. That's civil wars, world wars, heck, recessions, depressions, doesn't matter. They have always paid above their minimum guarantee. Those are the kind of companies that I like to trust my money with and recommend clients do too. There's no stupid limits or penalties. Guys, you don't have that 59.5 age rule. If somebody wants to retire when they're in their 20s, they can do it with this if they want to use this as like a retirement method, right? Because you can take tax-free retirement from it and you do it early. There's no limits in the sense that you don't have to, be locked in like Roth IRA, which has the same kind of tax rules. You're only allowed to put in $6,000 a year or $7,000 if you're older. Well, that's nothing to move the needle down the road, is it? But with this, you can dump in at least 25% of your stated gross annual income. So if you say, hey, I'm making $500,000 a year with my business or whatever, you can literally put in $125,000 a year, right? If you're making $100,000 a year, you can put in $25,000 a year. You're making $50,000, you put in $12,500 a year, right? You're basically limited to the income, but guys, you can put in way more money. I've had people putting in $500,000, sometimes more per year into this kind of plan. Well, I've also got people putting in $5,000 a year. It could be $500,000 or $5,000 a year as a max contribution. So there's lots of ways to do that. Bank leverage. I'll talk about that in a minute, but that's exactly what Walt Disney did because he didn't have enough cash. So what did they do? He went and got a home equity line of credit and he used the cash from his policy that they use as collateral. They locked it up so that they would give him the loan for that bank. Definitely thanks for the reminder, Danielle. If you got questions, definitely leave them in the comments. We'll put that in there for sure. And here's the best thing, guys, and this is what we're talking about today as well, is that it protects your family because it does provide that death benefit, that tax-free benefit to make sure your family's taken care of if you were to die young. But also, even if you live to that ripe old age of 120, it also helps you provide a legacy where your money can keep growing even when you're gone within your family so that they don't blow all your money. I'll talk about what that means too later. And the best thing I love about it is the access to cash now. And that's what I kind of want to talk about here. Here are the different ways to use it. Here's how I use it. One, I use it for my emergency fund. Because let's be honest, if you have an emergency fund sitting in a bank earning 0.nothing%, and then you get taxed on 0.nothing%, you're not feeling too happy, are you? The great thing about this is it pays, like I said, it's currently paying at least 5 or 6% a year tax-free dividends. Now, net of cost, like you might still be looking at least 4 or 5% or more per year. But still, if I'm earning that tax-free kind of dividend, That's huge. It's like a high yield savings account that's tax free. And so I remember, we're looking at for our family, our situation, we're looking to have a very generous amount sitting there for emergencies. So we decided to have $400,000 sitting there we don't touch. Now, 400,000, if it makes 0.1% that my credit union is currently paying on a savings account right now, that means I only make 400 bucks a year. And then I get taxed on that 400 bucks. So if I'm lucky, I walk away with 300 bucks after I pay taxes on that money. But I told my wife, I said, listen, what if we kind of earmark 300,000 that's inside of our life insurance plans? We earmark that money that we don't touch. We don't invest it. We don't use it. It's just there as reserves, but it's earning much better returns, earning over a 5% tax-free return on that money. We keep it there because even at 5%, guys, even if I go low on this, 5% tax-free means I'm making 15,000 a year on that 300,000, but I still have the other 100,000 in a local bank or even high yield savings accounts. I could split between those two, which I did, so that I'm making at least maybe $100+ a year on that money. So I'm making way more money than most people do just letting it sit in a bank or even a high yield savings account. And I have one less tax return form to deal with because I have to report the interest to the IRS. I report nothing to the IRS when it comes to this money. Collateral. And I talked about that. Like I mentioned Walt Disney, I even had my own client that said, Chris, I don't really care about this life insurance stuff. I don't care about the death benefit. I don't care. Basically, I don't care about my family at all. They can figure things out. He did, but he's like, I got 300,000 sitting in cash in this account. I'm thinking about just cashing it all out and then using this to buy my building because he wanted to open a practice and have his own building. I said, well, how much money do you need? He said, well, with build out, maybe 375,000. So this will help. I said, well, before you just cash it out, which you could do, why don't we ask the bank to see if they'll be willing to use this as collateral for giving you a loan? Because they already have the building, but if you have this extra double collateral, maybe they'll give you some better terms. So we went to his credit union. They said, yes, we would love to lock up that 300,000, that he's going to cash out anyways. But instead of locking up in equity in the property, they gave him a loan, and they gave him a loan, guys, at like, this is very similar interest rates to what we see today. He would have normally paid at least 6% on his commercial loan. They gave him a 3.75% mortgage rate on his loan. They lowered it over 2% below the going rate. His payment was like $1,800 a month, had enough money for the build out. So they gave him 375,000, even though there's only 300,000 in the policy, gave him all that money. He was able to build it out. He got a renter in there that was able to pay for his mortgage payment. So he's literally working in his office, his practice, rent free. And then on top of that, a year and a half later, went back to the bank and said, hey, can I take the lien off the life insurance now that the building's all done? And they said, yes. And they kept the terms the same. He would never have had that same interest rate had he not done that strategy in the first place. He was able to do that. And now he's at the 300,000. He could do whatever he wants with it. So guys, collateral, banks love it as collateral. Extra retirement income. This is what most people talk about. They talk about supplemental retirement. Yes, you can actually take tax-free retirement income from this. I've noticed that usually you can run out the numbers for a long time. You only pull out maybe 7 or 8% of it, even because there's no ups and downs like the stock market. That's why you can only pull out 3% a year if you want to stay retired at least for 20 years or so in the stock market. Here, you can usually pull out about 7 or 8% per year and not run out of money before you die. So you can do that too. Kids savings. Now, we have a guy on our team right now where his dad had owned businesses, stock traded, did real estate, did about every investment or business under the sun. He even had ownership in a stock trading education company that was sold to TD Ameritrade years ago. And yet, if you ask him what is his favorite investment, quote unquote, right? This is not an investment, obviously, but if you ask him his favorite place where he's put his money, he will say out of everything, the one place he always knows is certain is this that we're talking about right here. He always knew it was going to be there. He didn't have to worry about paying taxes on it. It was always there, always growing, no matter what. Out of all those things. And here's a cool thing, guys, kind of going along with this kids savings. When the guy that works on our team, Parker, that you guys can actually book a call with later on, Parker, when he was just a teenager in high school, he set up a policy in his name, in his son's name. So he set up a policy in his name, but Parker didn't have access to all this cash. It was all his dad's cash. His dad had control of all the money. He could invest with it, do whatever he wants with it. But he said, hey, down the road, when he's an adult, I might turn this money over to him. Well, as he went to be an adult, he wanted to use this for his college savings potentially, but Parker was able to get his Stafford loans. By the way, key point here, guys. The great thing about this is that, like I mentioned, if you get sued, they can't touch your money. The IRS, they don't tax it. Now, if you want to get a mortgage then this counts as cash reserves, liquid reserves that they count if you're trying to get a loan. By the way, I just send my statements now for my life insurance. I don't even send my bank statements anymore. I just send my life insurance statements, say, look, I've got cash reserves. And the bank say check. But the other thing too, guys, that's kind of cool is that when it comes to getting financial aid for your kids for college, they do not count this as an asset. Even though it's an asset for the banks when you're getting a loan, they do not count it as an asset when you're trying to get your kids scholarships, grants, and other financial aid. So as a result, Parker was able to go to college, got really interest-free student loans the whole time he's in college. And then after he got out, his dad finally said, you know what? I'm going to gift this to you. I'm going to turn this over and put it in your name. And you can use it to pay off your tuition for your college versus the 529 plan, which more and more people hate lately. He had more flexibility, but instead Parker said, I'm not going to use this to pay off my tuition. I'm actually going to use this to start a business. And so he did that instead, made more than enough money to then pay off his cheap student loans anyways, right? So guys, this is a lot more people over and over are saying, I hate my 529 plan. Plus, what if my kid gets a full ride scholarship? They won't need it. What if my kid doesn't go to college? What if they go do a vocational trade? What if they end up becoming an entrepreneur? They won't even need this money. How can I plan for the future when I don't have a crystal ball? You don't have to worry about that with this. You can use this for whatever the heck you want, right? And go along with that, cash flowing investments is the other thing. Cash flowing investments, this is where it can be pretty cool. I'll talk about that in just a minute here. Now, people always ask, well, how do I fund this thing? How do I use this? Do I dump in a bunch of cash, like dump in all my savings here? My answer is no, do not do that. In fact, there are plenty of insurance agents that want you to do that. Why? Because the more you dump in, the higher the death benefit has to be to keep it tax-free. That's the IRS rules, right? So if you want to dump in 500,000, a death benefit has to be a certain amount depending on your age and health rating. Well, if you want to do 50,000 a year, guess what? It's going to be about a tenth of that death benefit. If it's 5,000 a year, there's about a tenth of that death benefit, give or take, right? So the death benefit has to go up. That also means the insurance costs go up. So many of them will say, yeah, dump in a ton of cash up front. Why? Because the first year is the year that the insurance agent gets paid the most money. Don't fall for that kind of scheme. It's not cool. Now, rarely it might make sense, but I generally don't recommend it. So I recommend years 1 through 3, use your emergency fund to invest in this or to save in this, right? The other money that you use to invest, don't touch it. That's the key thing. So many people say, well, do I put my investment money in here? The answer is upfront, no, don't do that. And even for some of my old clients, they might say, oh, this is new. Well, why? Because you have those net costs. In those first couple of years, there's a net cost coming out. Now, the way we design it, it's much more minimized compared to most. The vast majority of your money you're putting in up front is going to actual your cash account versus what I had where none of it went to the cash account those first 2 years. But the one thing is, the issue that we have here is that if you use your emergency fund, right? If you use the money here, now you don't have to worry about using your investment money that can generate more passive income. So say, for example, maybe you have $250,000 sitting on the sidelines. You could say, well, now I don't have to use this money to put into the plan. I'm just going to use my emergency fund to fund those first few years when there's a net cost. Basically, just move my money over, almost like moving your money from a savings account to a high yield savings account. And now you're going to a high yield tax-free savings account when you do it this way. Move your money over that way. So you diversify your emergency fund. You still have access to that cash that you can get to. Now you still have all your money to invest. So that $250,000, if you make 10% a year on that, now you're making $25,000 a year. But guess what's cool about that? Let's say you can just keep saving that $25,000 a year for the next couple of years. Now you have $50,000. You invest that, you earn a 10% return. Now you're earning $30,000 a year. What if that premium was only like $25,000 or $30,000 a year? You literally now have the actual cash flow without any money, extra money out of your pocket, the cash flow to actually pay for your own premiums. And then that's the money that goes in, which by that point is growing by more than what you're paying in anyways. There it becomes like an actual, like a tax-free supercharged savings account, because now, even despite the insurance costs coming out, your dividends from the insurance policy is paying more than the cost coming out of it. And now it's self-funding. It's actually paying for itself at that point. That's how I like to use it. And so that you can actually build wealth faster than what most people do. They say, throw all your money in, but then you kind of slow down your progress and trying to invest in those things because you lost some of that money to those insurance costs. Make sense? I'll show you kind of what I mean anyways. Now let's talk about those cash flowing investments. How does it work? How do you get paid on your money twice? Well, this could literally shave off years towards your financial independence. This is something you want to listen up to. All right. You have two options when it comes to money. You can either use your own cash or you borrow it from somebody else. That's pretty much it, right? If you're going to spend money, you either use your own cash or you borrow it. Here's the key thing that most people don't realize. You're always paying interest. Always. Even if you use cash, you're still paying interest. You might say, well, that doesn't make sense, Chris. I get borrowing money, loans, you pay interest. How is it that when I'm using my own savings account, I'm paying interest? Well, you're not paying interest to a bank per se, but once you use cash and you use that money to spend on something or to put into something, you've now lost the ability to earn interest in that very thing. That's called the opportunity cost, right? You no longer can earn interest. Now you might say, well, Chris, I'm going to take that money and invest it. Great, you're earning money in that one place. But what if you can get your money to pay you in two places at the same time, where you're earning interest at two places with that same cash? Let me explain. There's two different types of interest that we're talking about here. There's compounding interest and then there's simple interest. These are not the same. In fact, if you get nothing else out of this today, this is big. This will blow your mind. In fact, I just taught this literally just over an hour and a half ago to another group, and it blew the mind of somebody who was already one of my clients because she's like, I didn't see it until just now. This is a big concept. This changes everything. So let's pretend you get a mortgage, right? You're going to get a mortgage for $300,000. If you have a 6% mortgage, say it's a 30-year mortgage, you will pay $347,000 in interest, paying your minimum payments over those 30 years. Now, I used to be a mortgage broker in the mid 2000s. I would tell people, you know what? This is robbery. If you have a 300,000 mortgage, you pay 347,000 interest. That's like paying for two mortgages. I'm like, so the best thing you can do is pay it off early. Now, while I was saying that, the mortgage company and the banks were saying, yes, thank you, Chris. Keep teaching them that. Why? Because they want you to pay off the mortgage early. If they wanted you to pay it off later, you know what they would do? They would say, let's give you the best interest rate for paying long term because I'll compound my money faster. Just so you know, banks do not earn compounding interest on your mortgage. They earn simple interest. You pay them simple interest on a loan because you're paying principal and interest. It doesn't compound against you. You don't pay more and more in interest each month, do you? As you pay down that loan, you pay less and less to interest, more and more to principal. Not because the banks are screwing you over. It's all because you are actually paying down the mortgage, meaning it's just simple math. That's it. That interest, that 6% interest is just charging less and less in interest as you're paying down the loan balance, right? That's the difference. So I would tell people all the time, yeah, pay it off early. But that's exactly what any investor would say. Any investor would love for you to pay off that loan early because the more money they get back, the more they can lend out. Because if they got that 10-to-1 ratio, you pay an extra $1,000 of principal on your mortgage payment, they now have the ability to lend out $10,000 to other people or even yourself possibly. They love it when you pay it back early. Just like if you're an investor, a passive investor, you lend out your money to another investor, they're paying you interest. You want to make sure you've got equity that's in that loan that you're doing. You don't want to pay them 100% and then possibly the real estate property is not worth that much. You'd rather just say, you know what, that property is worth 300,000. I'll loan you 200,000. And if you don't pay me back, then I'm going to take that property away from you. I'm going to foreclose on you and take that 300,000 property and get my money back, right? That's what banks love for you to do. They want you to pay it off. Now, that's a little extra bonus I'm giving you there. That's not exactly the point I'm making, but here's the thing is you will pay 347,000 of interest over those 30 years if you pay minimum payments. But what if you had 300,000 that you could pay off your mortgage today to save that 347,000, but you didn't? Maybe you kept it in a CD earning 3%. What if you got 3% on $300,000 in 30 years, right? What would that look like? If 6% on a mortgage, paying that over 30 years, 347,000, what do you guys think would be the amount of interest you would be paid from the bank if you put in a 3% CD for 30 years? What do you guys think? Now, I know by the time you guys put in your responses here, the questions, I'm not going to see the answer. I have some people do the price of right thing. They'll say $1 because everybody throws out numbers, right? But here's the answer, guys. If you earn 3% on $300,000 in 30 years, you have $428,000 you've earned in interest. That's on top of the $300,000 in there. Now you might be thinking like, wait a minute, how in the heck, if it was 300, we'll go back here, right? 347,000 in interest at 6%. How is it half the interest rate paying me almost $100,000 more? Guys, that's it. It's compounding interest. You compound interest in the bank, don't you? When you save money, it compounds interest. You're not pulling the money out. Well, you could, but you're not. You're compounding it, right? That 100,000 becomes 103,000 next year. And 103,000 becomes 106,000 and change the next year. Then it becomes 109,000 and some more change. Then it becomes maybe 113,000 next year and so on and so forth. It has that little curve that goes up like this. Well, when you pay on a loan, it goes down like this. Guys, if you earn even the same interest rate as that 6%. If you only earn 6% on that 300,000 and not paid off your mortgage early, guess what? You're in 1.4 million. You walk away with an extra $1.1 million net. Do you care about that 347,000 if you knew you could make 1.4 million over that period of time? Probably not. What if you earn 10%? Guys, that's almost 5 million bucks. 347,000 doesn't sound like much compared to that. You earn 15%, which I've had several properties pay even more than that. So that's $20 million in 30 years. I don't even go above that number because most people don't think it's true or it's real. But the fact remains, if you're doing real estate investing or business, it's easy a lot of times to get those kind of returns in different investments. So $20 million. Do you think I care about the 347,000? Guys, this is exactly why last year when I went to buy a new car, I had the money to buy it in cash, but we didn't because they came back. They said, "Hey, if you want to finance it," because I said, "Well, tell me your financing options. I'm curious." They said, "Yeah, if you finance it for 3 years, we have a special. We only charge you 3.9% interest." I said, "Deal. I'm taking it." Because I know I can make way more than 3.9%. And I know I'm paying simple interest to them. Just so you know, to beat the interest rate on a 5-year car loan, all you have to do is earn half the interest rate and you match exactly how much you pay them in interest is exactly what you make in compounding interest over that same 5-year period of time. With a mortgage, you have to earn half the interest rate. So if you have I have a 2.75% mortgage that I got on this mortgage about 3 years ago, exactly 3 years ago this week. Well, 2.75%, I only have to earn, guys, about 1.3% on my money, even if I could pay this thing outright in cash, which I almost have enough cash to do that right now, but I don't because I know I can make so much more. You guys understand this? Are you guys with me so far? I know I haven't asked you many questions, but is this making sense? Is this blowing anybody else's mind about how compounding interest is way cooler than simple interest? You guys get that? Because I hope you do, because this is why when people say, "Well, Chris, why would I pay interest from using my own money inside this life insurance policy? Why would I borrow my own money?" And the answer is you don't. You don't borrow your own money. Lewis, I love how I gotta show this here. I love how you say, like, you get this. Lewis is like, hell yeah, that's right. So this is the thing. If you understand that, even if you have an interest rate on the policy loan, right? When you're borrowing from the insurance company, you don't borrow your own money. You borrow from the insurance company like they are the bank, but they know that your money's in there as collateral because it's guaranteed. It's always going to grow. They know it's safe. So the insurance company has no problem giving you a loan up to 95% of the cash that you have in there. And they'll charge you maybe slightly more than what you're being paid on interest, but it doesn't matter because they're paying you compounding interest where if you do this right, you actually you pay simple interest to them, allowing you to earn net gains on your interest that you get paid from them. So here's how it works. Most people just take money out of savings and invest it, and then they take the cash flow from that investment to go back in their savings account until it builds up enough to reinvest again, right? Simple enough. We're just doing the same thing with the money that's above and beyond whatever you want to keep there for emergency reserves. This is the key thing, right? Anything that you have free to invest or use or save, whatever you want to use, you actually use that from your policy instead of your savings account, because I can borrow from the insurance company. And here's the cool thing with loans from insurance companies. They charge you interest. Yes. Right now they're right around 6%, but they're also paying pretty darn close to about 6% or so. But here's the cool thing, guys, is that the loan payment, there is no minimum monthly payment. You pay back however, whenever you want. Your deadline for paying it back is your death, is when you're dead. And they just take it out of your death benefit and then pay the rest of your family tax-free, right? That's how they get paid back. Why are they willing to do that? Because they're still charging you interest. Now, if you've never paid on a loan, here's the key thing. Yes, that interest will compound against you. But if you're using this for cash flowing investments, or if you're using this in your business to generate more revenue in your business, and then you take the proceeds, the profits from that to pay this down, guys, this is where it gets to be cool. Because say you want to borrow $100,000. Now the $100,000 is still sitting in there, growing and compounding inside your life insurance policy. You're still earning tax-free interest in there. Now you borrow the $100,000 from the insurance company, you go use an investment, say it pays you 10%, that's $10,000 a year. You now use that to pay back towards a loan. It'll pay down some of the principal as well as the interest that's from that year. But now you've paid it down. Guess what? The next year, they charge you less interest because now the balance is a little bit less. You do it again, the 10,000 goes back in. By the way, every time you pay down that balance, that money's now freed up to then turn around and reinvest again. So you can keep reinvesting that money. Same thing as if you put into a savings account, we're just now using this as a savings account to help build that cash. So, I know I have this example here, like taking a loan, but let's just use this example here with a small apartment. Say that it's apartment that's $1 million. You put $250,000 down. You put 25% down on this building. Now, I wanted to use a comparison. What if this compares to using a savings account versus using the strategy? Because many people will say, yeah, but I don't have to deal with the insurance costs. I don't have to deal with the interest of the insurance company. I'll just use my savings account. Well, cool. Well, when you drain your savings account, you're not earning any interest anymore, are you? And so that 2,500 a month or 30,000 a year is slowly building back up, and you're earning that point nothing percent. Say you earn 0.2% on that money after 9 years and being taxed on that money. Guess what you're left with? $1,200 of interest. That's it. Because again, you depleted your funds to zero. But the opposite's true with the life insurance. Your 250,000 is still in there earning tax-free compounding interest. Here's the great thing, guys. I actually use my own scenario. I'm in my mid 40s, right? So I would use my own policy as an example. If you're in your 30s, it could be better, it could be more or less, just depending, but I'll use my own situation. Now, when I did this, I took out the interest I had to pay the insurance company. I did not count that as part of these profits. I was like, what is my net profit after I pay them interest? Here's what it is after 9 years. 126,000. Now I'll ask you guys a question. You could type in the chat here. Which would you rather have? $1,200 after 9 years of extra interest, or 126,000 of extra interest, which is 100 times more? I know it's not going to take a rocket scientist. I know it's pretty obvious. Obviously, I go for this. Now, yeah, it was over 9 years, but think about what 9 years, 125,000 plus can do, right? I know, Danielle, it is an easy answer, isn't it? It's obvious. This is the one we're going with here. Well, guys, that's exactly what it is. Like that 126,000 that's like a whole extra investment that could be cash flowing you maybe $10,000 a month, right? Or sorry, not a month. That would be awesome. It could do that, but that's probably only be in your own business if it's going to happen anywhere. In real estate, it might be like an extra $12,000 or $1,000 a month, $12,000 a year, something like that. That's huge. That still could be the difference between you retiring at age 60 or retiring maybe at age 55, depending on your situation, right? Or if you're in your 30s right now, it could be the difference between you retiring at 45 versus 40 or whatever, right? It's a big difference. And that's where I love arbitrage, right? That's how you make money twice. You got a fever and the only prescription is more arbitrage along with more cowbell, isn't it? So here's how the process works. You first open up your max ROI infinite banking policy, right? You get that started. We, of course, can help design and set those up for you. Love to help you there. 2, you fund it with your emergency savings for those first few years. But then as the cash builds and you start to use other cash as well, then you start to use that for investment for passive income. You use the cash flow investment to pay down the loan balances. And then you do that over and over. And it actually allows you to become work optional faster, because especially when you're investing this in like passive investments, passive income type of investments, which we love, we support, then you can actually retire faster. Now, I actually have a guy he's actually in his late 20s. He said, I got a plan to by 2029, I can actually retire. Now, here's what he's did. He already has some investment properties. He wanted to buy at least one property a year with the cash flow he's earning. And he's also has his insurance policy too. Now, he showed me this and I said, well, I see in 2029, you got about 4,400 of cash flow. Well, that's not enough. You're not at 5,000 a month like you wanted. He says, Chris, I don't need to be, because I can literally pull out another $950 a month. You can see towards the top there, there's that $950 a month that he put there as well. I thought he was kind of overestimating, to be honest. I said, $950 a month. Could you really pull that out of the policy you're paying 15 grand a year into? I ran the numbers and he was exactly right. And that's just based on the current interest projections. Right now, they're already predicting 2025 to pay higher interest. Could actually be more. But I was like, no, you're absolutely right. At that year, you could pull out $950 a month tax-free. And so I said, yeah, you could actually do that. Assuming all things work out with your real estate, you got it. Guys, he would be retired in his 30s with $5,000 a month of passive income. That's awesome. And just the fact that even helped him get there a little faster makes all sense. Now, some people will say, well, buy term, invest the difference versus doing this strategy, right? Why not just buy cheap term, invest the difference? Well, I decided to take one step further to be devil's advocate against my own point. I said, what if you didn't buy any term at all? What if you just compare this to simply using a savings account? So I used the example, just like I mentioned before, someone had $250,000 that they could invest, plus they're saving another $30,000 a year to add to that they maybe stop putting in a 401k and they want to do more passive investing instead. Well, that first year, you see in the yellow, 55,000 adds another 5,500 to their 25 grand a year, earning 10%. They're at 30,500. Now, if they started doing that with insurance, they won't have as much to invest because obviously some of it came out. They still use their 250,000 to invest, but then they use their 30,000 to fund the policy that they were saving in their 401k. but now they're putting in here instead because they don't want the age limitations and all the dumb little rules that they put on you. Well, guess what? Yeah, you have less cash flow in that first year because you have those insurance costs. But notice that by year 10, at the end here, they got 112,000 if they just use a savings account, 121,000 using the life insurance. Now, the first 5 years, yeah, you're losing. And the first really 8 years, you're still losing to the other side. But because by that 10th year, there was extra cash still in the policy that they could then leverage and use because they're getting paid so much in dividends, they were able to use that to be able to have a little extra boost in year 10 to then be able to hit the 121,000 versus the 112. Are you guys with me so far? Is this looking good? Are you guys understand this so far? I know I get a lot of text. I just don't know if it's from you guys or not. So, anyways, yeah, I always have to look. 'Cause sometimes I wonder if my team's saying like, "Hey, we can't see you right now" or something like that. Okay, now IULs like Index Universal Life policies become very popular in the last 15 years. Why? Because the stock market has only gone down once in 15 years. But guys, understand that the stock market does go down. Usually, for every 4 or 5 up years, there's 2 down years. Well, if that means every 5 years you have 2 down years, in 15 years we've only had 1 down year, we're overdue for another 5. I can't even use the right number. There we go. 5. There it is. 5 years that we're actually out of whack, out of the actual average of what the stock market does. Guys, IULs, the problem is the costs go up every year. Even if you don't lose money from the interest returns, and maybe they put a 0 or a 1% guarantee on it, but even if you get that, guys, and the market doesn't perform for a couple of years in a row, you'll notice that the costs will actually start eating into the policy, especially if you want to try to use it for retirement income. So even though I sold these before they were popular back in the early 2000s, I found out pretty quickly there's no certainty, there's no predictability. You don't even get the double dip with most of these policies. If you try to borrow from them, you stop earning interest on that money. So you can't get that extra interest that you're earning on the side in addition to the investing you're doing. So as a result, not to mention surrender fees and everything else that makes it so that you can't really access the cash early on anyways, it's not my favorite tool of choice. For myself, even though I can write my own Index Universal Life, I never do because I just don't trust them. Not to mention they can change the returns on them whenever they want, and that's not cool either. Now, even if you could do it, apples to apples, I've had like this IUL sent to me by somebody. Still, we end up kicking the crap out of it. Like the net cash surrender value you see in year 1 is 0 because the surrender fees are too high. In mine, you've got cash in it, even though you're paying that, I can't remember if I see that 12,000 or so a year. It's smaller on my screen than maybe it is for yours. Now, I asked some people, especially in the real estate space, I said, hey, why do you do this? What is it about this that you like so much? And here's the answer I got from one guy, Neil. He said, reduce risk to exposure to banks. He didn't want to have to deal with bank failures. And on top of that, he wanted that creditor protection in the event that something happens that's beyond your control. Protect your money, right? Protect your money from the bank failures, protect your money from lawsuits. Ron, he said kind of the same thing. And he even asked me at a mastermind, he was asking like, hey, anybody have an answer about where I can store my money? Because Chase Bank's paying me nothing right now. And even though I have millions with them, they still don't treat me, they treat me like crap. And everybody was saying, well, just put it in another bank, put it in a high yield savings account. I raised my hand. I said, Ron, you already have one of these. You already know what to do. You have an infinite banking policy you're putting money into. Why not do it again? So he did. He set up a second policy. By the way, you can have unlimited number of policies as long as the death benefit's not too high for compared to the income you make per year. So you can actually have multiple policies. So he set up a second one that's twice as big as the first one he did because he didn't want to keep his money in the bank. And not to mention, he said the same thing. Very few insurance companies have ever failed in history. So he trusts to put his money there. This person in particular, this guy is a dentist. He said, hey, I wish I knew about this years ago. I'll tell you, I hear this all the time. People are like, where were you 20 years ago? I wish I'd known about this 20 years ago. Maybe you've said the same thing. I tell people 20 years ago, you wouldn't want to know me because I was a financial advisor. I was a schmuck. So, I wouldn't have done anything good for you anyways 20 years ago. But I'll tell you right now is better than waiting for 20 years before you finally decide to do something like this. But they say the same thing. They're like, I just wish I would have done this sooner. This guy actually is in his 60s. He said, hey, I'm doing it because I want that double dip, right? I want to have that my money working for me twice. He's like, not to mention it's tax-free and it's good collateral, protected from lawsuits and creditors. He's like, he loves that. Now, there are other infinite banking people out there, but I'll tell you, every time I run across it, man, like when you see other people's whole life policies, here's the thing. You can only tell if you're getting something good if you compare apples to apples. So here's an example right here where this is a Northwestern Mutual policy. I love showing Northwestern Mutual because one, everybody knows some Northwestern Mutual agent that's probably in his 20s, brand new in the business that's doing that. Because once you get wiser, you realize Northwestern Mutual sucks to work for. But the reason they suck is because they're so expensive in their insurance costs. That's why we don't use them. And of course, Northwestern, the only thing they can say is, well, we've been around a long time. We have a lot of money. Yeah, you have a lot of money because you charge people a lot of money. Duh. But you'll see this, like if you can see it here, you'll see in the yellow highlighted, the first year, this person was putting in 22,000 a year. There's only $400 in year one. Ours was over 17,000 bucks. So already we're saving them over 17,000 in costs in just that first year. Even down the road, you'll see like down like 13, almost 15 years down the road, you'll see that finally you have as much cash as what you paid in. With ours, we highlight in yellow, ours actually did it in year 6. It almost did in year 5. But in this person's situation, it took till the 6th year where you had more money in it than what you've paid into it. So we destroy almost any other infinite banking you see out there. Even traditional infinite banking, like this is one that it's like the one I set up for myself. This one actually was done by the person that I know. Actually, she set up Robert Kiyosaki, Rich Dad Poor Dad's policy, and great woman, but designed it horribly. And here's what she did: 30,000 a year, but the minimum is also roughly about 30,000 a year. Ugh, guys, that drives me nuts. Not to mention, of course, that it takes forever before you finally have some money. And even then, later on, those later years, it's showing you paying into it forever. We don't do that. I had a situation with another dentist, where they said, "Hey, Chris, can you look at ours and see if it's any good?" And they had it for like 5-7 years, depending on the policy. They had like 4 different policies with different companies and whatnot. And I said, "It's probably okay, but sure, for you, I'll double check." We actually ran apples to apples numbers, even though you have to start a new policy with new fees up front and everything else. To my surprise, in just 20 years, they were paying $150,000 a year. In just 20 years, they would have $2.25 million more in our policy, with all things being equal. So paying no more money than what they're paying today, but they would have $2.25 million more. Just out of curiosity, I know I asked really hard questions in this masterclass here, but how many of you would like to have $2.25 million more by doing nothing extra? Right? Needless to say, they replaced it. They end up getting a new policy, and now it's much more efficient. It even pays for itself already. They don't even have to pay into it if they don't want to. It already pays plenty in dividends. But guys, and by the way, here's the other thing, because people will say, well, how do you make it so much better? We lower the death benefit. We do a lower death benefit, the minimum death benefit needed to allow whatever amount of cash is going in. The crazy thing is, even in those 20 years, they would still have $4 million more death benefit than the other guy. Again, same thing, running out apples to apples, right? It's crazy. Now, this is what our typical policies could look like, where if someone wants a max fund for 8 years, as an example, here's an example, you're max funding for 20,000 a year, but notice the minimum is just under 4,000 a year. So you're only required to pay about that 4,000 a year, but you can contribute up to 20,000 a year. That's pretty typical. If you have a 20,000 max, the minimum is like 4,000 or 5,000 a year, depending on your age and your health. It could be more or less, but that's pretty typical. So you're not required to have to pay in that 20,000 a year, but you have the option to. You can always pay less in our policies, but you can never pay more. Now, if you want to pay 25,000 in this policy, it won't let you. If you do that, it will trigger taxes, because we do it right up to that line. But we give you a lot more flexibility, and you have a lot more cash. Notice that the cash is almost $16,000 in just year one, right? And even then, I show you, look on the right-hand side too, as you pay the minimums, and I have them stop paying the minimums after their 60s, their mid-60s, their cash is already growing. And I can't see it, but I know it's a lot. I think it's like 80,000 a year, something like that. That's showing it growing tax-free without them paying a dime. So you don't even have to pay into this. Even though it's a whole life policy, you don't have to pay into this your whole life. Technically, you only have to pay into it for 7 years. And even then, and a lot of times people get that 7th year, they say, well, I want to keep paying because this thing's growing by more than what I'm putting in. Why not throw money in? I can always pull it back out later if I want it, right? So that's kind of works. This person actually is in their mid-50s, had okay health. They were I put them as average health is what they had here. Their minimum is about 6,000 a year for that 20,000. But notice I have them stop paying after the 9th year. I said, great, you're done. And it still keeps growing guaranteed year after year. So that's kind of what I mean by unbanking yourself, right? It's getting away with that. So review, best way to fund it. First 3 years, use your emergency fund. 2 to 3 years, do that. And then after that, then start using your own cash that you're using, that you've already been saving anyways. Use that to start building, and then you can use it for investing to get that double dip effect. As I also said, it's tax-free, protected from lawsuits, creditors, 100% in most states. There are some states that don't give you 100% protection, but there are very few. And the majority of states have that creditor and lawsuit protection. Safer than the bank? Definitely safer than the stock market, that's for sure. Guaranteed growth of at least, right now they're currently paying at least 5 or 6%. None of those dumb, stupid limits or 59.5 rules or whatever penalties they have. Bank leverage, you can protect your family legacy and keep that going forever, right? You can not just protect your family now, but also protect generations. Notice I've barely said anything about the death benefit, right? And that's where we're going next. Now, before I get into that about the death benefit and the power to pass on from generation to generation, just so you know, I'm offering anybody here a free consult, right? So we do not charge for our consults at all. If you ever decide to do a policy with us, we get paid by the insurance company directly. You never pay out of pocket for this. So we're offering a free consult. And anybody who actually does a policy, guess what? We give you access to a Wealth Accelerator Academy for free. So that's something that you usually pay at least $1,500 to be able to have access to. That's where we teach about our cash flow secrets, how to save money on taxes, especially if you're a business owner, ways to free up cash flow, even invest for passive income, and what are the different types of investments you can do. We talk about all of that in that academy. It's an online interactive education portal that you can use, where we even do monthly calls as well, live with myself, to talk about these different things, these different aspects. So that's something that comes for free if you end up even set up a policy, right? But again, don't reach out to us. Do not book an appointment unless, one, you're not over the age of 70. Two, you're not in horrible health unless you have somebody else in your family that could do it with better health. And then three, if you can save at least 5 or 10,000 a year, that's great. Unless you just want to set up a simple term insurance plan, you can let us know that too, right? Here's how you can actually book that call. And you can actually do that. You can scan the QR code, but I know sometimes you not always have that ability to scan the QR code. So I also put the link there too. It's a long one, right? Calendly.com/parkermoney/infinite-banking-consultation-masterclass. Ideally, QR code just takes you right there, helps you be able to book the call. We already just had a huge thing that we did yesterday. There was 400 people on that book calls all the way into September. We try to open up a few more slots for you guys. So if you're watching the recording, you might want to jump on it sooner than later. If you're watching it live, you already have the advantage, but definitely see if you can book a call if this is something you feel like I need to see more. How does this work in my situation? Again, free consult to do that. All right, so let's talk about that death benefit, right? And thank you, Danielle. Put that link also in the comment section too, so you can actually use that link there as well. So you can check the comments on the YouTube or on the StreamYard thing here. Now the death benefit, what about that? Now we know it protects the family, but that doesn't help you till after you're dead. But what about your legacy, right? Now, you guys may or may not recognize this picture. This is John D. Rockefeller. Now, Rockefeller, obviously pretty famous guy. Here's why. Actually, let me go back. But this guy obviously was wealthy. In fact, in today's dollars, based on when he was the first billionaire in the US, based on today's dollars, he would have been worth almost the same as Elon Musk and Bezos combined, right? Having those two combined, he had about that same net worth by the time he died. Now, what you may not realize is this, right? Is that he actually set up a plan to ensure that his estate keeps passing on from generation to generation and they don't lose money. Contrast this with the Vanderbilts. The Vanderbilts lost all their wealth by about the third or fourth generation. Vanderbilts were actually more wealthy, but because they didn't have a good plan in place, they didn't teach their people. They created a bunch of trust fund babies. By the way, Anderson Cooper is one of those heirs of the Vanderbilt estate. He was only left with $100,000 by the time it got passed down to him, versus the billions of dollars it should have been. So there was nothing there. But with Rockefeller, he actually passed it down, and the wealth kept growing as it passed on to the family members. Here's how he did it. So he set up life insurance policies on himself, set up on his family members. When they passed away, it all paid into the family bank, the trust. It all paid into the trust here. Now, obviously, while you're alive, you could still use the build wealth, like we just talked about, right? And I taught you how to do that. Now, as you're using this, you have your own policy, you have your spouse policy. People always ask, well, whose policy should I do first? Usually it's between you or your spouse first, kids second, right? And we can help you decide what makes sense. Do you do one on both of you, each of you as spouses? Do you do the kids too? Do you just one of you? We can kind of play the scenarios to see which makes sense if you're going to start out with just one. But that's the thing, is that the beneficiary becomes your trust that you set up with the attorney. Now the trust then dictates how they get access to money. But when you put in the trust, you actually say, no, they don't just get money thrown at them, especially if they're not ready for it. They have to borrow from the estate. They have to borrow from that trust. They have to borrow the money from the family bank here. So, I like to call mine the bomb, right? It's the bomb, Bank of Miles, I know it's kind of cheesy, but, we call it the bomb, right? all those the death benefits pay into that. So even when not just when I pass away, not just when the spouse passes away, right? But also when my kids pass away, it pays into this estate. And then when they get, when you have other kids, grandkids, great grandkids, as they're born, they also get insurance set up on them to then pay as the beneficiary, the estate goes into that family bank, right? Now, the cool thing is when they pay back that money they borrow, they pay back with interest so that you ensure that the money keeps coming back. Yeah, you could give them money, of course. You could give them a certain allotment of money. But the great thing is that you're teaching them to be wise stewards. Because here's the thing: is it just the money you want to pass on, or do you want to pass them on more? How about how to create the same wealth that you were able to create in your own life? What if you were able to teach them that younger so that they actually surpass you in wealth than what you were able to do? And then that pays into the family bank. And then your estate, your legacy can continue on forever. This is what Rockefeller did, but he didn't always do that. See, at 38 years old, he had controlled 90% of the refineries out there, the oil refineries. Age 50, he was the richest man in the US. But at age 53, just 3 years later, after becoming the richest man in the US, he all of a sudden was expected to die. All the medical experts could not figure out what was going on. The guy lost all of his hair. He couldn't eat. He couldn't sleep. All he could eat was soup and crackers. The guy had lost all really passion for life. He stopped smiling. He was not happy at all. And in the middle of that, even after he was expected to die, he woke up one morning. He said, "You know what? Why do I have all this money? Why have all this wealth? Who cares? It doesn't buy me my life. What is my life really about?" And he started realizing, like, you know what? It's got to be more than just the money. This money, actually, I've been trying to work so hard for so long to create all this wealth, and for what? And so he created that year, he created the John D. Rockefeller Foundation. What's interesting is his sicknesses went away. He all of a sudden got healthier. He actually didn't die for another 45 years after he created that foundation. He then became later the first billionaire in their history. Like I said, combined, he was way richer than any of the billionaires today, right? Depending on the stock market in the day, of course. But I mean, the guy became a very billionaire, but he became more than just about the money. It became about a mission. In fact, this quote he wrote in his journal before he died, he wrote this. He says, "God taught me that everything belongs to him." Stewardship, right? "And I am merely a conduit to carry out his will. My life has been one long happy holiday since then, full of work and play." Guys, he created that legacy that now is passed on from generation to generation, not just the money, but also what he stood for. That foundation, by the way, also helped fund penicillin just a few years later, which obviously has made quite a big difference in the medical community and so on. Like that foundation has done more than just help his family. It's helped many, many others. Guys, that's just like my dad. I mentioned I went to see him last week, surprised him for his 80th birthday. He's not going to be able to pass on a lot of money to us, right? Like he's stretching out all the dollars he can because he lived a lot longer than he expected. Heck, none of us thought he would live to age 70, and he's made it to age 80 despite all the heart attacks and strokes and everything he's had. He's still here on this planet, thank goodness. But the great thing is, it's not just about him, it's about the values he passed on to me of that hard work and integrity, right? Your word is your bond. Make sure that you're serving and helping other people. And that's something I can pass on to my kids too. That's something that's worth more than the money. Cool thing is you could pass on the money too and allow that mission, that word is your bond, that service, that ability to serve people. Heck, the whole reason I call the company Money Ripples is that ripple effect I can create through people's lives. Because as you're blessed financially, you can bless the lives of those around you. You have a great capacity to be a better blessing, just like Rockefeller did. You may not do it as a billionaire. You might be a multi-millionaire. Either way, you can pass on that legacy from generation to generation. That is the whole goal of this ultimately. You can use it now to create wealth and in the future too. It's not about working harder or smarter. It's about working right. Okay. I know we're going maybe over time from what some of you expect, but I know many of you are still hanging in here. Questions. Let's see if you got any questions here. Let's put them in. Again, it takes a few seconds for me to see the questions, so be sure to type that in. Any question you want to have. In the meantime, I'll put up that link once more so you can see that. So here's a link you can book a call with Parker and be able to get on that, and do it quickly because, like I said, we just opened up more spots because we were booking out to September after doing that webinar for 400 people last night. So definitely, if you want to do that, be sure to be able to schedule that link with him. And so let's open up for questions. Any question you have? I see a lot of comments from this. Love the hell yeah. Definitely, again, love that you guys have joined in here today. But let's see if any questions. Anything about how this works, whether you're alive, dead, otherwise, let's answer some of those questions at this point right now. All right, I'll leave this up here in the meantime too while I'm starting to read through this. All right. One question I get a lot of times here, and I'm seeing this right now. One question that people will say is, "Well, how much money do I put in per year? How do I decide that?" The best way to do that, guys, is I just figure out what your cash flow situation is. So, for example, if someone says, "Hey, I've basically got 20,000 a year. I'm saving. I'm putting away, whether it be into a 401k, I'm max funding it or whatever, but maybe I'll use that money instead." Often we'll put the max that you can contribute a little bit less than that 20,000. So if it's 20,000 you can put away, we usually put the max at 15,000, knowing that your minimum might be around 3,000, 3,500 bucks. So that usually within a few months, you have more than enough to pay that minimum premium. And just so you know, it's flexible. Like I said, the minimum is all the insurance company cares about. The maximum is what you care about because the more you pay closer to that max, the more the cash value grows. That extra you're paying in just builds that cash faster and faster. So we always try to go based off that. Someone says, "Hey, I can save 100,000 a year." We get like dentists and people like that say that, or doctors. Great, let's put the max at 80,000 a year, right? So we try not to make sure it's anything that's stressful. Oh, here's the cool thing too, because there's money in there from day one, and because we just recommend using your emergency fund to fund that in the first part, anyways. The great thing is people will say, "Well, what if I can't even do the minimum? What if I can't even do that few thousand a year? Like if things are really dire." The great thing is, guys, if you've got cash in there, guess what? You just borrow from the cash to pay the premium again. And of course, when you borrow from the cash to pay the premium, it's going right back in to pay in. So, whoops, just knock that over. Here, I'm going to go to my uh, normal screen here. There we go. So we go from like the cash just goes right back in. It's almost like pulling from your savings account to then put it back in your savings account again. So that's the great thing is you can keep it going. I've had people that literally for years have not been able to pay premiums because life hit them hard, whether they had some real bad economic situations, layoffs, whatever it might be. I was like, it's okay. Just let the premium pay for itself. Once you hit that seventh year, we can even stop paying the premiums altogether. Stop borrowing from the policy to pay the premiums. Just pay off the loans, and whatever's left is left. So it can actually cover your whole entire life. So it's really cool that way. All right. Okay, guys, I appreciate you joining here today. I thought that was a great question. If you have other questions, you can always ask us one-on-one, of course. Again, feel free to book that call, book that time with Parker if you want to be able to see how that works. But guys, the thing is, we're here because we just don't trust anybody else to do it for us. If we could find somebody to do that, we would never even do this ourselves. But I know that this can be an amazing tool when used right, not only to protect your family and create a legacy, but also something to help you create more wealth and financial freedom faster. So reach out to us with any questions you guys have. Make it a great day.